Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. Today, we are going to be looking at CME Group stock. This one came in by request. If you have a stock you would like me to analyze, just drop it in the comments section, and I'll get it on my list. And I will eventually make a video analysis of it. If it's in the S&P 500, I post those for free here on YouTube. And if it's not in the S&P 500, then I post those over on Patreon, which is $5 a month. And then if you join over on Patreon, you get a big discount if you want to the full Cyclical Investors Club service over on Seeking Alpha. Those links will be in the description. If you are not interested in joining the Patreon, you can just go directly to the Seeking Alpha link down below, and you can just join directly too. So that's up to you. So today we're looking at CME Group stock. I hadn't looked. I do track this one in my spreadsheet along with about 5 or 600 other stocks that kind of meet my basic standards that I keep an eye on to see if they ever fall to prices that I find really attractive. I actually did not recall ever writing on CME Group before, but when I checked, I did write one article in 2019. Almost 4 years ago now, before COVID, and that was a sell article based on valuation for CME, and I have that pulled up here. We can see that it was a sell article. They've returned about only half of what the S&P 500 has returned. If you divide 20% by 4, just roughly, you're looking at like a 5% annual return. And I think it's been showing some weakness recently. So I would say this was a pretty good sell call. You could make more money just owning the S&P 500 index over this time period. And I would also say we haven't even had a recession yet, and I would expect, as we'll see, that CME will get hit harder in a recession. So I would call that a good sell call on a otherwise like high quality business. So I always like to review any coverage I've had of a stock because I don't get into like talking about the businesses and creating stories too much around it, except for as it relates to future earnings or stock price fluctuations in the short term, if it's like a macro thing and cyclical and things. That's like what I specialize in. So I like to kind of just show the basic techniques that I've used, that they do work most of the time. And I didn't know whether this was going to be a good, decent call when I looked it up or not, but it was. And I haven't followed up on it since then because it's kind of just been in the middle, like nowhere land basically since then. So with that out of the way, let's take a look at the first thing I like to always check is the long-term earnings cyclicality of a business. So that's going to be this shaded green area down here in the fast graph. And what I like to look at first are the drawdowns, the historical drawdowns. So that's going to be these red numbers. And if we look during the Great Recession, that their earnings actually only fell about 18%. And then we had a pretty weak year in 2012, and then they fell about 11% there as well. And then really pretty much since I wrote about them, well, I don't have that. Well, at the time I was writing about them in 2019, they basically had flat earnings. So they hadn't grown much then, but then the growth does pick up during the kind of COVID stimulus years, these past couple of years. But really what I focus on are these drawdowns. 18% during the Great Recession is not a lot. I would consider this, in terms of earnings, a moderately cyclical earning business, basically. So not a deep cyclical. And that means that we can use earnings if we look, as long as we include like a full cycle of data and we're just careful with what we're looking at, we can use earnings to help project what they might earn in the future, right? Because they don't fluctuate a ton, as long as you take into account the years where they do fluctuate a little bit. So that's what I try to do. That's what I was doing back in 2019. So if we just think back to where we were, one of the nice things about these fast graphs, I think you can even get more detailed on these now. I haven't played with their new updates yet, but if we just go back to the end of 2019 when I was writing about it before, when I framed that time frame, I almost certainly would have started about 2006 or 7. Maybe gotten into, since that was kind of a big upcycle, I could go back and read my article, but I might have started here. But I probably started somewhere around here to get a full cycle's worth of data, so we capture this down cycle. And I would have tried to see how they had grown earnings over this whole period in order to estimate kind of what they might do in the future. But I like to take into account these down years, because that just gives you a better picture. If you were actually own this business and you were collecting earnings, they don't just go in like a straight line like this. They have ups years and down years, even if it's not super cyclical. And if you don't take those down years into consideration, it'd be like owning a business that has some bad years where you can't make much money, but then pretending kind of like they don't exist as long as it recovers. And that's not really how it works. Like if you were actually using this business to, if you owned the business, and you were using that money to live on, right? So that's how I like to think about all this. Now, what really jumps out at me is not the earnings cyclicality, but it's the price cyclicality. So when you look at this, you can see they were trading at we'll call it a 47 PE at the peak going into the Great Recession. And while the earnings only fell 18%, then they had another decline a little bit later, and you can see they're kind of weak that whole period. But while they only fell 18% during the actual recession, the stock price fell at least over 75%. That's probably more like an 80% if we went from peak to trough. So that's a huge price decline. Now, part of that price decline is attributable to their high valuation going into the Great Recession. And then when they came out of it, they did not immediately go back to this high valuation. And so what I call this situation where you have a fast-growing stock, it goes through a slow period, and then basically when they come out of that, growth is like slower than it was in the past. What happens is the market often will re-rate the stock at a lower average PE ratio. So the average PE during this period was probably like 35 or 40. And then the average PE, take this weak period out, even after they start growing again, the average PE is like 25, right? So that I call a multiple compression cycle. Most quality stocks go through that at some point in time. I mean, you think of Microsoft from the mid 90s or the late 90s until this same period here, and it went from like a 60 or a 80 PE down to like a 15 PE, right? But they grew earnings almost that entire time. I think they had one soft year. It was kind of like, it wasn't even as soft as CME's, but the market just re-rated that growth rate and just felt differently about the stock. So they have that multiple compression cycle and probably will never average that high PE again. So that's okay. But it's good to know that it is the type, probably I would attribute, well, we can look at it, but I would attribute part of this to the high valuation, this level of stock price decline. But part of it also to just how the market treats a business like this during a market or economic, both basically, contraction. So to get a little bit more of a clue, we can peek at this 2020 drawdown, even though we know it was like really short and very unusual. And we can say, okay, well, going into this, they didn't have a 47 peak PE. They had like a 32, we'll call it. 32 or 33. And during even that short decline, earnings basically were flat. They didn't really fall very much. And the stock still lost like 30%. So we get a sense that this fluctuation in earnings or in stock price is typically going to be greater than the underlying earnings cyclicality. Hopefully this is making sense. Basically what I'm saying is the stock price is more volatile than the actual earnings, and by a lot, by a big magnitude, like at least 5 times more probably than the underlying earnings. You can expect the stock price to fluctuate. This can be really good for investors that understand this, and really scary and bad for investors that don't understand it. So I didn't own this one, but it was January of 2022. I went through and I had a lot of financial stocks. I wrote an article on this. I'm not going to pull it up right now, but I sold a lot of my financial stocks that had this profile of really big price cyclicality and not and like moderate earnings cyclicality. And I went through and I sold almost every single one of them that I had still owned that I hadn't taken profits in, because I thought that we were going to have economic weakness, at least the threat of like a recession, with stimulus money ending and student loans being paid back. Now, it took a long time for all those things to actually, and interest rates rising, and it took a long time for all those things to actually happen, because a lot of them were delayed over these past couple of years. But just now, with the last kind of student loan peg has been put into place. And so, but those dangers actually started where I first saw them, and I was one of the only people really writing about this, was in January of 2022. So if I had owned this stock, this is where I would have sold it before, and it's come back a little bit, but before that 25% decline in less than a year. So, and it actually probably would be what will end up being the peak. And the reason I would have done that is because I understood the historical dynamics of what this stock has done in the past. Now, this one is a lot bigger than what we'll probably experience, because the peak PE going in was higher, but you can go down and look at where it would have had a similar PE after it already started falling, like right about here, right? And then you can look down and you can say, well, it still would lost 65% from that point, even if you didn't have it, even if you didn't own it at the peak. So, and I will show you how I take this into consideration when trying to figure out where to potentially buy the stock if we have a downturn. So, and I do think we're at risk. I don't know the timing, I don't know the depth, but I think we are in a risky time period still, as we've been since the beginning of 2022. And we're still in a bear market since 2022, so I think that all still stands. So that's a lot of context on the earnings and price cyclicality, but they're really important for a stock like this for investors to understand that you can look at the fundamentals, they can look good, but you have a lot of price risk. So if you're willing to hold through that and you don't care about the price fluctuation and you think you got a good deal, that's fine. But what you don't want to do is be completely unaware, look down, the stock is down 60% from when you bought it, and you just give up and throw in the towel and say, man, I got this one wrong, and then you sell it, right? Like, let's say it goes down next year 50%, and you come and you're like, well, it's tax loss harvesting time, I'm just going to sell this one. Well, that would probably be the wrong thing to do unless something really fundamentally went wrong. But what you really want to do, in my opinion, is avoid those big drawdowns. The little ones aren't so bad, but when you get 50% or more potential drawdown, that's usually kind of where I draw the line. So all that, think about all that, and with that, we'll start to analyze it based on earnings, and then I'll also analyze it based on a potential recession. I have a feeling this is going to be a long video on what I thought was going to be an easy one. Okay, so in order to value the stock, I like to look at how much I could collect in earnings as an owner of the business over the next 10 years. And the way I do that is I look at a past time period leading up to where we are and see what they've done, and I kind of make a few adjustments maybe and then extrapolate that out to the future. So the way I do with that, I need two things. I need the earnings yield, which is the inverse of the PE ratio. So you take the earnings, you divide it by the price, that'll give you an earnings yield. And then I also want an estimate on earnings growth. So for earnings growth, I go back and I go year by year, and I see how earnings would have grown if I just had invested $100 over this time period. And for this one, I go from 2015 to 2023, and I leave out 2018 because this was a big tax cut year. And as you can see, they had a very unusual year with a lot of earnings growth because they got to keep a bunch of money they otherwise would have paid in taxes. But that only happens once, right, in terms of the growth. They get to keep that savings as long as the tax cuts are in place, but it doesn't grow from a year where they didn't have to pay the taxes, right? So take that out, and then I estimate the earnings growth rate, and then I use those two things to figure out a business owner's earnings CAGR, I guess is what you would call it. So for that, we go to my spreadsheet. So when I calculate the earnings growth, I get 8.21%. I also take into account buybacks. These guys didn't really have any, so that wasn't a factor. They also don't really have a bunch of debt, so that's not really a factor. So those things are pretty easy. And then compare mine to the Fast Graphs growth rate. Slightly more conservative, probably because I did not include this big year. And so I'm like at 8% something. They're a little closer to 10, but we're still ballpark in the same area. So what I do is I look at their current earnings yield, which is about 4%, 4.05%. This also takes into account any little amounts of debt that they might have or not have. Let's see here. Very little amount. So I add it basically to the stock price. So I'm treating it like it's $225 a share instead of $217. So that's close to a 25 PE, a little less than a 25 PE. And the earnings yield, as we can see, on $100. So the way I think about this is if I bought the stock for $100, or I bought the whole business for $100, and I got to keep all the earnings for myself as the owner, I would get $4.05 a year, and that would grow at like 8% a year, right? So I pull the first year forward, and so I get $4.38. The other 100 is the original investment amount. So this $4 grows at 8% for 10 years. And I want to know what I end up with at the end, and I make an extra $64.09. And so I just plug that into a CAGR calculator, which is done in the spreadsheet. And that gives me this business owner's 10-year earnings CAGR, which is 5%, 5.8% actually. So 5% is the threshold that I use to roughly decide like when to potentially sell. So like below 5% is when I would for valuation. So it's slightly below that. It's basically right on the line. And I think if I owned this, I would definitely be, just based on the market is a little cheaper than this. So even though the market's kind of expensive too. So I would consider potentially selling this just based on this if I owned it, but you could justify going either way depending on what other opportunities are in the market. Now, in terms of looking to buy it, obviously if it's close to a sell, I wouldn't buy it. But the other thing to look at is this 3-year revenue number. So this is cumulative revenue growth over a 3-year period, which is only 8.61%. So if you think you divide that by about 3, you're looking at like a 2 to 3% revenue growth over an annual revenue growth over 3 years. I don't usually buy stocks nowadays if this is under 10%, unless we're in a recession. There's like a reason for it. There's a clear explanation for it. Maybe it's a boom bust from the pandemic. So and you could maybe make the case that is what's going on here too. But that's just an additional sign of weakness is how I would think about it in this context. Now, if this was negative, I would sell. Again, if they're all other things equal, there wasn't like a clear explanation for it, like a recession or something. So this is another sign of weakness. This is a sign of overvaluedness. So that's how I would describe it in an otherwise quality business, right? So when to buy? Well, I like to so in order to buy, assuming earnings stay track as we would expect them to, which isn't always the case, but that's what we have to do when we're projecting into the future. I want the price to fall, which will raise this, and when that crosses 8%, that's when I would consider buying the stock. It would do that at about $120 per share, so it would need to fall about 45% from here to become a buy. All right, based on just basic earnings and earnings growth. Presumably, this wouldn't be negative, or it would, be totally explainable like during a recession. Maybe we could ignore it. Now, the second thing that I'll look at And what's interesting, so this is my basic number, and then if I think we're in danger of having a recession, which I do, then I have an additional way that I look at stocks that looks at past recessions to try to get us, one, to avoid big potential drawdowns, like I was talking about earlier with those price drawdowns, but two, to maybe get lower prices. In some cases, to get lower prices. In other cases, it's just to have a way when earnings look really bad to come in when everything's really bad and buy at a reasonable price when other people are focusing on current earnings. You kind of think of the historical cyclicality and that those earnings will come back. So that's what this next recession PE thing is designed to do. Now, interestingly, at this point in time, these are both almost exactly the same. So, but if earnings decline going forward, this number will go down and actually get worse. So it will get lower and lower, while this one will basically stay the same. Because it's based on peak earnings. And I think right now I'm using forward earnings for this, but assuming they can hit their earnings for the rest of this year at 914, then it would be valid. Now, if this ends up being lower, that recession buy price would go lower. So the way that I do this, and I think this is pretty reasonably important to think about for this stock in particular, because it can have these big price fluctuations, is I look at the low price, which, if I move myself here, was $31.10 in 2008, and I look at the peak earnings, which was $3.23, and I create a PE ratio out of that, which is 9.6, if I remember correctly. And so what I want to do is I want to assume the same thing could happen this time, and that the market might treat the stock the same way again. So I say, okay, we'll take whatever this peak ends up being. I think right now I have it at 914. And let's say these earnings years are lower. Well, I wouldn't pay attention to those because I'm going to assume eventually that it recovers. And I'm going to look at the price compared to this peak price and create a PE ratio there. Now, this kind of PE ratio is really like peak pessimistic thinking, right? So you have the highest price, or the lowest price, and the highest earnings, and that creates kind of this really pessimistic PE. And then in my mind to say, okay, how close am I willing to get to that before I would consider buying? Usually when something's like a low, like a single digit PE, if I get within like 40% of that during a downturn and everything else looks okay, that's usually when I'm willing to come in and buy that. So that's what this spreadsheet is set up for this particular stock. Now you can choose whatever you want to do yourself. So if you want to try to get it just exactly as low as it was in 2008, then I could take that 40% bonus off and I can just show you what it would be. So then you would be looking at a 61% decline, and you would from here, and an $84 recession PE target. So you can adjust that however you wish. I never get more generous than 40%. So that's kind of my maximum generosity. And that would be buying it at like a 1344 recession PE. So, and the reason that you do that is you don't want to miss out on every stock. What if we have like a mild recession, right? And it just things don't get as negative as they were in 2008, which they were very negative. So you really it gives you a base to work from. It gives you a kind of a stable price during a recession when things are fluctuating a lot. It just kind of gives you an anchor to hang on to. And then you can decide how much leeway you want to give a particular business compared to 2008 or 2020, depending on what kind of recession you're looking at. So I thought it was pretty interesting that these numbers are pretty close. For me, since I think that we still have a pretty good chance of having a recession, I mean, we might have a soft landing, but I think investors should be prepared for a recession when they're dealing with their stocks, thinking about what to buy. This is not one I would want to buy going into recession. And I would say, given that big historical price swing that it's had in the past, given the revenue weakness, And given the high valuation, this would be a sell for me if I owned it right now. Just unless a person was very convinced that recession, like we already bottomed and we're heading out of the bear market, and the economy is going to be fine and all that. So if you think all that, then it would be a hold. Me, I'm more cautious. I've seen what this stock price does during recessions, and that's not something I want to experience. I already sold all my stocks that were like this almost 2 years ago. So I would definitely be like a seller here, I think. I bet in a recession it would underperform like an equal weighted S&P 500 index. All right, that ended up being a little more complicated, but I think you probably learned a lot because it has some pretty clear dynamics that are easier to explain than some other stocks. Yeah, if you found this useful, hit the subscribe button. If you have any stocks you want me to look at, put them in the comments section. I usually respond once I put them on my board that's behind me here, and eventually I will get to those, and I'll see everybody later.